The question has been posed, what insurance companies do infinite banking?
No insurance company does infinite banking. It's people who do infinite banking.
Infinite banking is a process. It's not a product sold by an insurance company. But people who do infinite banking do use certain life insurance products sold by certain life insurance companies to maximize results with the infinite banking concept.
This question is just one of the conflicting ideas that have risen about infinite banking. And that's why McPhee Insurance is hosting a seminar this coming May 2nd and 3rd right here in Indianapolis to make infinite banking simple again. We're going to discuss all the things that happen around infinite banking, what it takes to be successful at it, and how infinite banking is like a bank. Insurance companies and banks operate very similar. In fact, as Nelson Nash said in his book, if you switch the board of directors from a bank and an insurance company every week, people really wouldn't notice the difference because they're operating very similar.
Banks do have some differences with the way they operate in that they can lend out money they don't have. That's called fractional reserve banking. Insurance companies can't do that, but otherwise their functions are very similar. They're taking money from people. In the bank's case, they're getting money from depositors. In the insurance company's case, they're getting money from people that are paying life insurance premiums. Then they do something with that money. They usually invest it to make sure it's earning a return. They have to keep certain amounts in reserve. And then they have to be ready, in the life insurance company's case, they have to be ready to pay the death benefits. They have to be ready to give policy loans to people that have products that build cash value. So they're making those types of loans. A bank, on the other hand, they have to be ready to lend money out to people that are using credit cards, to people that are buying cars, to people that are buying houses, people that are starting businesses. They're lending money out to make a profit. It's one of the investments the bank is making.
And sometimes we wonder just how ready they are to do that, because if you say you're depositing your money to a certain bank and then you go in and say, hey, I would like to get a loan. I'm starting a business. It's amazing all the paperwork that you have to fill out, all the things that you have to list and supply, the tax information, all of that, to try to sell the bank on your idea. They have your money. They have no problem taking that. But then you've got to sell your idea of your business and prove that you don't need the money that you want them to lend to you. And that's very different than the insurance company. When you deposit money to them, you're purchasing insurance and you're also purchasing paid up insurance. And then they say, we'll loan you money. And so you go to them with, you've got a business idea and you want some money. You don't have to tell them any of that. All you need to do is say, I would like to borrow some money. And sometimes you might need to, sign your signature. I want to borrow money, and they loan it to you.
And the reason they can do that is because it's a fully collateralized loan with the life insurance company. With a bank, it's not a fully collateralized loan. If you don't pay that back, they've got a big problem.
And they've got a bigger problem because banks are fractionally reserve lending. They don't always have the money on hand that they're lending out. They can loan $10 for every $1 that's deposited with them, at least. And so when that happens, it makes the underwriting process have to be much more strict, because it doesn't take very many people, not paying their loans back before this bank has a run on the bank. And that's why so many banks have closed down, because they have not been able to meet those needs, where there's very, very few life insurance companies that do that.
Say, for example, that you have money deposited at a bank. You could go into that bank and ask for a loan using the money that you have on deposit as collateral. It's probably going to be easier to get that loan if you do have the money on deposit as collateral, but then you have to tie up that money in order to get the loan from the bank. So most people, they don't want to use the money they have on deposit with the bank as collateral. They want a loan that's based on other things. With a life insurance company, when you take a policy loan, it's always fully collateralized, because the amount that you can borrow is dependent upon how much that you have put in to premiums and how much cash value has built there to collateralize a policy loan.
The banks have the FDIC protecting your dollars that are on deposit there. So up to $250,000, FDIC protects that. With the insurance companies, there is no FDIC. So people ask, well, is my money protected? And yes, it is. Insurance companies are not allowed to go bankrupt. They can go insolvent. And if they do that, life insurance companies have reinsurers. So other insurance companies behind them that reinsure. So when we have seen insurance companies go insolvent, all the policies that have been written have been absorbed by those reinsurers. And sometimes people see this. They have a life insurance company with ABC, and suddenly it has been changed to their life insurance policy is now with XYZ. And they still get the same guarantees that they were given by ABC before they went insolvent. So both banks and life insurance companies have protection.
The other thing that life insurance companies do in all 50 states is they voluntarily have organized to have a guarantee association. And so part of every little premium dollar that's sold funds this guarantee association, and it guarantees up to $300,000 in every policy that's sold, similar to what the FDIC does for a bank. So there's lots of similarities between banks, how they operate, and how insurance companies operate. But the difference is that very, very few insurance companies have ever gone insolvent, where there's a big number of banks that go insolvent.
Going all the way back to the Great Depression, when the banks closed for a bank holiday and they reopened and so many people didn't have the money that was there on deposit, some of the banks I don't think ever reopened, that the life insurance companies, they had a half holiday at the same time. They had the money to give to policy owners, but they had to keep some money on reserve to be able to pay death benefits and continue operating. So they spaced people's policy loans out over time. And that's what seems to have got a lot of people through the Great Depression.
That reminds me of It's a Wonderful Life with Jimmy Stewart. And when he had his savings and loan and there was a run on it because of Potter's evil doings, well, he just begged his customers to take $20 to get him through the week, and he would have the money next week. They could have another $20. And because of his goodwill that he had spread among the community, his depositors listened to him, and he saved the savings and loan. That's exactly what insurance companies did when they had their half holiday. Whereas banks just closed and Monday morning they opened up and a lot of accounts were empty, and some banks, like you said, never opened again. That money was just gone. Insurance companies are more secure than banks, and part of that is because of the fractional reserve lending that banks do.
So with our question today, what insurance companies do infinite banking? No insurance companies do infinite banking, but are some insurance companies better to use with infinite banking? Perhaps that's a better question.
Yes, indeed. There are definitely certain insurance companies that are better to use with infinite banking. And one of those factors that we look at is the insurance company a mutual insurance company, or are they a stock-held insurance company? There's a big difference between that, because insurance companies that are stock-held are trying to make profits for the stockholders. Insurance companies that are mutual, they don't have any stockholders. The policy owners are the owners of the company because it's a mutual company. So they have to be careful in the way that they manage their money. They have to collect more in premiums because there's no stockholders to fill in the gap. And then when they make a profit, they have to share those profits back with the policy owners because there's no stockholders in the picture. And that gives a benefit to the mutual policy owners because now they're sharing in the profits of the company like an owner of that company.
The stock-held companies have a little bit more pressure on them because of their stockholders. They're looking for quarterly profits, whereas mutual companies, they don't have that pressure, and they tend to invest in more stable things like real estate and bonds, and they can extend their profits over a longer period of time because they're not having stockholders look at those quarterly statements and saying, we didn't make any money this quarter. This company's not investing our money right. So it's important that we try to put our policies that we're going to practice at infinite banking with a mutually held company so that we get the advantage of any shares that come our way instead of it going to the stockholders first.
Yeah, we get more profit potential with our infinite banking system. Now, just because a company starts out mutual doesn't mean it stays mutual, because companies can demutualize and become stock-held companies. Are those companies still good for infinite banking if you had bought a policy for using with the infinite banking concept before they demutualized?
Well, I think we have to look at Nelson Nash again, the founder of the infinite banking concept. He had policies that never really had dividends or paid up insurance in that contract until way late in the contract. And it took 20-some years for him to get to a point where he finally realized, hey, I can get money out of my policies cheaper than I can with the banks right now. So, yes, you can use those. Just plan on waiting for 20, 25 years before you start using it.
So it takes a lot longer.
What we try to do when we design a policy is we try to find a mutual company that also has what's called a paid-up additions rider or advanced paid insurance or prepaid insurance, or it's called all kinds of different things, but it's a rider that's attached to a whole life policy that allows you to make extra payments and buy more insurance that's completely paid for. Now, to understand this completely, we have to realize that when we buy a whole life insurance policy, it's very much like buying anything else on time. We make a payment and we own part of it, but we don't own it all. If we die, our beneficiaries get the whole death benefit, but we don't own that whole death benefit. It's kind of like renting it until it's complete, renting to own. And every time we make a payment, a little bit of that death benefit gets paid off. Well, when it gets paid off, it's called paid up, and now it has a cash value associated with it or equity. Some life insurance companies allow us to buy a paid up rider where we just make a payment directly to paid up insurance. And that accelerates the cash value growth, which allows us to use the infinite banking much quicker and more efficiently than without the paid up rider.
When we're looking for an insurance company to use to use their product with the infinite banking concept, we're looking for companies whose illustrations of what the guaranteed values are going to be are very high. When our clients pay a premium, we want them to have the highest cash value available to them so that when they use the infinite banking concept, they have more money to use. So we want the guaranteed values to be very high.
That's a very important point, because if the guaranteed values are high, the guaranteed values will continue to be high even if the company demutualizes. We have seen that happen to an insurance company, and the policies that were written with very high guaranteed values are good to keep with that company, even though it has demutualized, because you can't get such high cash values if you were to switch companies and try to start over, building it at the new starting point.
The very first policy that we purchased on my life when we found about infinite banking, that company demutualized. It was bought out by a stock-held company, and the dividends went to zero.
Okay.
And we looked, this is bad, because we heard all this about dividends and everything. And no, the guarantees in that contract had to roll over to the new company. They had to honor that contract because it's a unilateral contract. They can't change it. And so when I looked at my premium and I looked at my guaranteed cash value growth for that year, there was a 33% growth on my premium dollar that showed up in my cash value. So I wasn't getting rid of that policy. That's a great return on my premium dollar.
When we come back from the break, we are going to talk more about cash value life insurance and what we're looking at in a good policy for infinite banking.
If infinite banking is a simple process, why does it seem so complicated? Could it be that infinite banking started out as something simple, but over time has morphed into a convoluted series of buying insurance policies to borrow from insurance policies so you can pay interest on your own money and somehow come out ahead? Could it be that infinite banking has been turned into a catchphrase and is marketed to seem exclusive, something for just the super wealthy or financially savvy? We think the answers to both of these questions are yes, so that's why we're holding a seminar called Infinite Banking Made Simple. This seminar will give you everything you need to know about infinite banking, what it is, and how it works. No mind-bending magic, no number gymnastics, just infinite banking made simple. If you're new to infinite banking, if you're somewhat familiar with infinite banking, or if you've known about infinite banking for a long time, this is the seminar for you. We will be covering infinite banking, what it is, how it works, and how to use it in your life. The seminar is scheduled for May 2nd and 3rd. That's a Friday and Saturday in Indianapolis. Make sure you schedule that time on your calendar now because, as you know, life finds a way to fill up even the most important dates. May 2nd and 3rd. Registration details are on the website linked here and in the description box below. May 2nd and 3rd, Indianapolis. We want to see you there.
The most important thing about policy design is good, solid guarantees. Those cannot be changed regardless of what happens to the contract or the company if it's bought out by another company. What can be changed are the non-guarantees, the dividend part of the contract. Dividends are projections and they are not guaranteed. They could be higher, lower, or non-existent. So always focus on the guaranteed values of a contract when you're buying a whole life insurance policy for infinite banking.
We say we want the highest guaranteed values. We do want to look for the best guaranteed values, but we're not going to artificially inflate cash values through the policy design either. Sometimes that is done by adding a term rider onto a policy. So you boost the death benefit up, and then you can put more into the paid up additions part of the policy. Sometimes this design is called a 90-10 because they're referring to the ratio, how much paid up additions to how much base insurance is going into the life insurance policy. But this goes counter to what Nelson Nash talked about when he talked about the ideal design for a life insurance policy that you're going to use with the infinite banking concept. He said you want to minimize the death benefit and maximize the cash value. Those two things together are very important because when you're talking about adding a term rider to a life insurance policy, to a whole life policy, now that's not minimizing the death benefit anymore. That additional death benefit that you're boosting up there with the term insurance, that comes with a cost.
It does. And speaking of costs, the third thing Nelson Nash said when you're designing a policy, you want the highest premium that the client can afford comfortably. There's no reason to skimp around on what we're putting to this if we really are sincere about doing infinite banking. Because the more money we can get in there is the more money that we can start using right away and recover in the cost of things that we're purchasing.
So Tom, and Nelson Nash said we should use the highest premium. We added the word comfortably because what we noticed in the industry is people would be coming to us. They had bought a policy from someone else and the premium was something they could not afford. It would be, sometimes we even saw one that was like 90% of their income.
That's not sustainable.
No, that's unaffordable. So yes, you want that premium as high as it can be, but you also want it to be sustainable. And so it's got to be comfortable. Now, we use that word. Sometimes it's got to be a little bit uncomfortable, especially if you're starting late, but it's got to be sustainable.
We talk about a minimum 10%, but when you talk about the financial planning world, they're saying 15 to 20% needs to be locked away, and if you're going to have a comfortable retirement. And so,
if you're thinking about using this for retirement purposes, then you might want to think about putting more than 10% away. And sometimes for people starting, 10% could be a good starting point, but we talk about the 10-20-70 principle. So 10% of your income, that's the least that you should be putting away to savings. 20% is the most that should be going to pay creditors. So that would be payments on credit cards, personal lines of credit, things like that. 70% is what you should be living on. So that includes things like your mortgage payment, your student loans, car payments sometimes go in that category, groceries, gas, all the things that go into funding your lifestyle. So when somebody starts a life insurance policy with 10% of their income, sometimes they have debt that they'll need to get rid of. Then that frees up the 20% of their income. So now they could save up to 30% of their income without working any harder. Some of that could certainly go to a life insurance, the premium on a life insurance policy. Some of it might go, so when they take policy loans out from the life insurance company to finance major purchases in their life, some of that 20% may go back to helping repay the policy loans.
And here's something really exciting. If you are really doing infinite banking, then you are going to be recovering part of that 70% in your lifestyle. And that is going to allow you to lock away even more in the infinite banking.
And when you say lock away, that means you'll be able to contribute more towards your premiums because you have more money that you're basically recycling.
Yes.
And you still have access to it. So it's not like locking money away in a 401k or something like that where you don't have access to it for so much of your lifetime.
It's locking it away for ourselves in the future.
It's locking it away for you to manage in the future. You still get to access that to use it wisely throughout your lifetime. Something that we have talked about, we want to make sure the guaranteed values are as high as possible for a life insurance policy. This changes. That's one reason we represent multiple companies is because the life insurance companies change their products over time. So the product that offers the best guaranteed values today, the guaranteed cash values, is not necessarily going to be the same company 5 years from now based on the products that they have. Now, this goes through trends with what's available in the industry. I remember one particular company, it's been a while back now, probably 7 to 10 years ago, their guaranteed values on their illustrations were really high. It was like way higher than anybody else in the industry. We talked to insurance executives with other life insurance companies. The only thing that they could think of was that they had made a really good investment that was going to pay out over a long term, and it was going to give them these really high, the ability to support those really high guaranteed cash values. That policy was only offered for a time. Now their guaranteed values have gone way down.
It's very important that we don't get all locked up in saying, oh, this is the company that's doing infinite banking. Because in the 20 years we've been doing infinite banking, we've seen different companies be an ideal company for a short period of time, and then they fade away because of, just like what you're saying, they no longer are offering those high guarantees anymore.
One of the things that is often brought up as a key point to being a good infinite banking life insurance company is the fact of whether they pay dividends based on direct recognition or non-direct recognition. You have a good way of explaining that. How much difference does that really make in the long run?
I don't think it makes a tremendous difference in the long run. In fact, in some ways, I like the direct recognition better than the indirect. Because a direct recognition company or policy, because some companies allow you to choose whether you want it to be direct or indirect when you take a loan. So in a direct recognition loan, the insurance company looks at your policy and see if there's a loan outstanding against it. And if they do, they say, we're going to lower your dividend share.
Why is that dividend lowered? Is it just because
they don't have opportunity to use that money someplace else where maybe they could get a higher return on it?
Okay.
Non-direct, they don't look at your policy to see if it has a loan against. So they just say everybody in this whole block of business that bought this kind of policy, we're just going to reduce their dividend anyway because we know some people are going to be taking loans. So in one, the non-direct, everybody subsidizes someone taking a loan. Whereas if I have a direct recognition, I subsidize myself and nobody else has to subsidize me. So it's not a huge factor one way or the other. And we have both direct and non-direct policy. So, I just prefer the direct myself personally.
That's a great explanation. There's some direct recognition life insurance companies that have low interest rate policy loans. And so when you tend to take a policy loan with those companies, if they have a low interest rate policy loan, you're going to tend to see a lower dividend. Some direct recognition companies have a higher interest rate for their policy loans. And so that tends to translate to a continued higher dividend because all the direct recognition policies are grouped together, but they're earning a higher rate on the policy loans that are outstanding.
And when we're talking about dividends too, we have to say that not all dividends are equal. So if I'm looking at policy X from company Y and it's got a high dividend and I look and see what is that dividend doing? What is it purchasing for me in this policy? And I see that it's, producing, for every dollar of dividend that's given me is buying me $2 of cash value.
That's pretty good.
If I go over here to this company and they've got a huge dividend, if company A has a huge dividend, but I see that their dividend is only buying me 50 cents on the dollar of cash value, I've got to say, what's going on here? What are dividends supposed to be? Well, dividends are unregulated. The insurance company can literally put anything they want to in that non-guaranteed dividend column. They're not bound to pay it. They're not bound to say how they came to it. They're not bound to say how they're going to pay it out. And so just because a company has higher dividends doesn't mean that it's going to translate to higher cash values, or even if you were to take the dividend as a payment, doesn't mean you're going to get 100% of what the dividend declaration was. Many companies that post high dividends, they haven't taken out all the expenses and costs associated with that dividend. They're just posting it before those have taken out. And when you say, well, I want a paycheck, send that money to me, they're going to minus all of that, subtract it all, and send you the difference. And that's why we see the difference in the cash value so discrepant between one company and another of what is this dividend buying in more paid up insurance and how is that affecting my cash value?
Some insurance companies are more friendly towards infinite banking, but if you call an insurance company and you're speaking to a representative over the phone, they may have no idea what you're talking about when you mention infinite banking, or they may not be able to answer your banking process questions. Which reminds me that one time Tom was talking to a prospective client and explaining the banking process of how banks take depositors' money and then they loan to other people or to other organizations, to businesses. And the prospect, who was a manager of a local bank, said, "So that's how my bank makes money."
It's really important to understand how banks make money so that you can make money like them in the infinite banking process. Again, infinite banking is a process. How do hard time economics affect the banking equation? That's a really good question to understand the answer to, because as interest rates go up in the economy or go down in the economy, it depends on whether we're going to access loans from the insurance company or if we're going to use cheaper money that's available someplace else. And we're still practicing infinite banking when we do that, because not all money managed in infinite banking has to come out of a policy loan.
Interest rates have been higher over the last couple of years, but we've come off of a period where interest rates were very low. During that time where interest rates were very low, we could get loans from a bank at a lesser rate than we could get from policy loans. And so what we did, we still funded the life insurance policies, but then we would often go and take a bank loan when we had an opportunity arise instead of taking a policy loan. Now, we would still use policy loans for short-term opportunities when we didn't want to go through the bank underwriting process. But then, having the money there in our life insurance policies was a source of liquidity. We could take a policy loan if we needed to, pad a few months of payments for the bank loan. It was a money management process. Now, today, when interest rates have risen for taking a policy loan from a bank, now we use policy loans more often. We've already established that source of funding either way. And that's why when you say we use infinite banking, whether interest rates are low or whether they are high, whether we're taking a policy loan from our life insurance policies or whether we're taking a loan from a traditional bank, we're still practicing the infinite banking concept, because the infinite banking concept is about wise money management.
Our client Jay met with Tom just the other day. He has a unique financial opportunity before him. They are having a new baby. It's their first baby. They are moving, building their new home, and he has some incredible investment opportunities in front of him. Jay wanted some counsel on how he should manage all this through his infinite banking. And because he has been funding life insurance policies for years, he has many different options available to him.
In conclusion, infinite banking is not practiced by any insurance company.
That's right. It's the people who practice infinite banking. It's a process.
We have identified 10 financial hurdles that middle-class Americans are facing. We're going to talk about those hurdles and how the infinite banking concept can help to overcome them. Next week, right here on Wealth Talks.